All right, class. Today we'll finish up the chapter 3 and we'll start chapter 4. So, the objectives to know about why we do financial statement analysis and what we should do to think about the long-term financial plan and the growth analysis for the corporations. This is briefly what we're going to learn today. So for today's class, my recommendations, listen to these videos, listen to what I'm explaining, what I'm saying for this class, and also have a read from the book of the relevant topics that I'm covering today. So far in chapter 3, we actually talked about how to do common sizing and how to do ratio analysis. So now, why we do those analysis, why we evaluate financial statements. So broadly, there are two usage, internal and external. So when you talk about internal usage, most of the corporations want to see if they have different department, different divisions. So if they have multiple divisions, they want to see which one is doing better, which one is not. So they can basically compare, they can basically evaluate the performance of different department and different divisions. So that is one of the usage from the corporation's internal side. Now also, sometimes they need to plan for the future. So they need to plan for future growth, future sales forecast, future financing. So they have to plan for the futures. So those kind of analyses actually help the corporations to plan for the futures. There are some external usage. So basically, creditors, suppliers, customers, stockholders, all these four entities are known as stakeholders. So stakeholders always wanted to analyze financial statements and want to get an idea about the corporation. So like from the creditors end, let's say they want to give you some money either for debt, bank loans, or bonds. So they want to evaluate your financial strength. Do you have sufficient money to pay interest and the loan value in future or not? So let's say, how much is your cash coverage ratio? How much is your existing long-term solvency? So creditors want to see that before giving you some money. So basically you means the corporation. Suppliers. Sometimes suppliers provide raw materials, inventories, other items in credit, like so you got the raw materials and inventories and you pay as a later date. In those cases, suppliers want to see your short-term solvency ratio, how much working capital you have, how much current ratio, quick ratio, cash ratio you have, so that you can pay back all those short-term liabilities or current liabilities. Stockholders. Sometimes stockholders want to analyze the stock value. They want to forecast for future growth so that they can identify whether this corporation is a good investment or not. So in short, all those stakeholders, before either giving you money, either giving you inventories in credit or investing in these corporations, they want to know about the corporations. And they can learn it, they can understand it by analyzing financial statement. Okay, so now how can we really analyze all those ratios? So when you talk about ratios standalone, when you just look at only one ratios, they are not helpful. I think I already explained in the class. If you only look at 2022 current ratio of Walmart, Tesla, Rivian, they are not helpful. We can do one of the two things to make ratio helpful for ourselves. First of all, we can do some time trend analysis. So let's say we want to see the current ratio of Walmart for last 5 years, 2028 to 2022. And we can see whether their current ratio is going up, going down, stays the same. That actually helps us to understand, okay, how much they did well or bad in terms of current ratios. Let's say we want to see what is the profitability ratios last 5 years. That will help us to understand how much they are profitable in the last 5 years. So time trend analysis is all about fixing one corporation and looking at that corporation's last 5, 3, or 10 years data, or basically 10 years ratios. Peer group analysis. So peer group analysis means comparing one corporation with a similar peer or similar competitor. So let's say Kroger, Costco are the peer group of Walmart or Sam's Club. So now we can see 2020 current ratio of Walmart with Sam's Club or Costco. And that's gonna help us to understand, okay, how much Walmart is doing poor or bad or doing good or bad as compared to its competitor. So if we compare the current ratio of Walmart with the competitors, if we compare the profitability of Walmart with the competitors, that actually help us to understand which corporation is doing better. So if we want to analyze ratios, one single value is not good for us. We can either do time trend or we can either do peer group. So that's going to be good for us. Some potential problems for doing ratio analysis. So basically, there is no certain threshold. There is no certain theory which value is exactly the good value or which value is a good indicator that the corporations have better performance, better financial strength. So there is no specific theories, specific or thresholds. So that's one of the problems. So it's all is intuitive. So we can look at last 5 years data for one corporation, so we can compare one corporation with the other. But if we want to compare one corporation with the other, sometimes it's really hard to find a benchmark. So benchmark is difficult to find because there are like a lot of corporations, those are diversified. So let's say we are talking about, want to compare Kroger with Walmart. Problem is Walmart do not only do groceries. Walmart do groceries, Walmart do a lot of other stuffs. Whereas Kroger is mostly dependent on groceries. So that's why it's tough to compare Walmart versus Kroger. Let's say Rivian versus Tesla, two electric vehicle corporations. Tesla is highly diversified than Rivian. So sometimes it's tough to compare Rivian and Tesla. And there are like a lot of other issues. Sometimes some corporations face extraordinary events, and as a result, it's tough to compare them with someone else. Sometimes they have different fiscal years. So sometimes maybe one corporation, so you want to follow that maintain January to December fiscal years. The other corporations you want to use as a competitor follow maybe April to March fiscal years. So sometimes those different time gap or different time length is a problem for comparison. So these are some potential problems that actually impede us to do some good ratio analysis. Okay, so this is all. So remaining things like why we do financial statement analysis, how can we do some good ratio analysis, and then what are some potential problems of ratio analysis. So moving on to chapter 4. Okay, so moving on to chapter 4. So what are you going to learn from chapter 4? Chapter 4 is all about long-term financial planning for any corporations. So in this chapter, we'll think about if we want to plan for tomorrow for any corporations, what are the factors we have to learn? What are the factors we have to understand? So this is the main objectives from chapter 4. So for financial planning, some key components we need to understand. So we have to think about for future, do we need to invest in any new fixed assets? So this is a capital budgeting decisions. If we need to invest in new fixed asset, where we'll get those financing? How can we source those financing? This is a capital structure decision. The money we are generating from the corporations, should we kept or should we distribute? All of our net income, should we pay to the stockholders as dividend or should we kept for future growth? This is our dividend policy. Now, how much working capital we should manage so that we have short-term solvency? This is in working capital decisions. So these are 4 components of financial planning. So some more things we need to know about financial planning, because when you run any business, there are some projects that is long run, there are some things that is short run. So when you talk about short run, that usually means less than 12 months. When you talk about long run, that usually means around more than 1 year to 5 years. So we have to keep it separate, our short run and long run decisions. Then we can combine everything together, and then we can think about one project at a time. But initially, we have to identify, for taking any new business, for taking any new projects, what are some short-run decisions, maybe net working capital, what are some long-run decisions, maybe investing in asset. Then we can combine together, aggregate one, and we can think about one projects. And for taking any new projects, for doing any financial planning, we have to be realistic. We have to be realistic about sales, cost, new fixed assets, working capital management. So all these important variables, we have to be realistic. How much we can generate, how much we have to invest, how much we have to pay. We have to be very, very realistic. And sometimes it is really, really essential to do some scenario checks. So when you talk about scenario analysis, we actually talk about by playing or by changing different variables at a time. And we're thinking about, okay, what could be the best case? What could be the worst case? So in general, when you want to take a new projects, we are more bothered about risk. So that means we are more bothered about considering the worst case, not the best case. So that's why we have to think about, if some bad things happen, what gonna be the results for our business. So let's say if we think our sales will go down by 15% next year, what should be our expected drop in net income? What should be our expected drop in the cash flows? Let's say our cost of goods sold will goes up by 15% next year. What should be the expected drop in the net income and cash flows? We can also do the best case by thinking about, if we can increase sales, if we can decrease the cost. This is our best case scenario, but we are more concerned about the worst case. So that's why it's really, really important to identify if some major variables changed and not going according to our plan, what should be the situation for our business. Now, importance of financial planning or role of financial planning. So that basically helped the managers to explore different opportunities, to explore different options, to think about, if multiple variables change at a time, what should be the interactive impact on the firm value. They also think about, like, if any accidents occur, what should we do, and how can we avoid those surprises and accidents. We have to think about ensuring feasibility. We have to think about consistency. So if we can do a good financial planning, if we can think about tomorrow, that's gonna help us a lot of things like new opportunities, managing accidents, and this is the role of financial planning. Now, how can we go for financial planning? How can we think about financial planning? So the very important factor in financial planning is to think about your business tomorrow. If that means you have to think about your revenue or sales tomorrow. So the financial planning, the first step starts with sales forecast. Now, when you talk about sales forecast, we have to be very, very careful, and we have to be cautious, because this is the most important item. This is the thing it will generate cash flow for the corporations. So in doing sales forecast, there are a lot of different options, a lot of different ways we can forecast sales. But one of the good ways is top-down approach. So basically, top-down approach means we have to start from the top, which is we have to think about the economy. So let's say we are talking about Walmart. These corporations does business in USA. So we have to think about US economy next year. Is the US economy will go up next year, or US economy will shrink next year because Fed is trying to raise interest rate? So that's our first step. Think about the economy that your corporations is doing business. Then think about the industry that your corporations is doing business. So Walmart, you can consider it as a retailer. You can consider it as a consumer staples, consumer good industry. So you can think about, okay, if US economy is going up 5% next year or 3% next year, what should this particular industry will do next year? Will it increase or not? After that, the third step, you have to think about, okay, if economy is going up, industry is also doing better, is my corporation should be able to continue the market share or not? So if my corporations is able to continue the market share, that means if economy going up, industry is also going up, my corporations will generate more sales next year. If economy is going by 5%, my industry will perform same way. And if my corporations can keep the market share, that means the corporations will enjoy some growth. Sales will go up next year. So that's the very first important. You have to think about what should be the sales next year. So upon doing the sales projections, the next is pretty easy. Now you have to forecast all other items. You have to forecast cost of goods sold. You have to forecast all of these things. Now you have to make sure the pro forma statement. Pro forma statement is all about a forecasted financial statement, a forecasted balance sheet, forecasted cash flow statement, forecasted income statement. So it's forecasted statements. And after we make the sales forecast, now we have to think about for future growth in sales, do we need to invest in fixed asset? Do we need to put more money to acquire some fixed assets? So now if we decided we need some more money for fixed asset in future, where we'll get the money? How much amount we'll need to pay for the asset? How much amount we need to financing those assets? After we know how much money we need, then the management will decide how they will source the money. Should they kept all those net income and invest in for fixed assets, or should they go for debt financing? So now when we talk about it's a management decisions, it's a decision variable. It is also known as plug variable. So by plug variable, that means management will decide, should you go for all net income, retain it, invest, or should we pay out the net income and issue some debt? So this is a management decision. This is a, I should say, decision variable. So we also call it as a plug variable. So quick wrap up. You have to start with sales forecast. What should be the sales tomorrow? Then you have to go for projected financial statement. And while projecting the financial statement, we have to think about, do we need more asset? If we need more asset, how we'll manage the financing? What should be the exact amount of financing? And how we'll manage? So how we'll manage is a decision variable by the management. So that's just a plug variable. Now let's think about some specific examples, how to forecast, how to make pro forma statement. So if you look here, these are historical statements, okay? Historical. 2018 balance sheet, 2018 income statement. Now, if you look carefully, revenues 2000, all costs 1600. So 80% goes to cost, 20% is profit, 20% of revenue is profit, 80% goes to cost. Look at the asset size, 1000, which is 50% of revenue. So revenue is 2000, 50% of revenue, 1000 is our total asset, 20% of revenue, 400 is our net income. We want to make pro forma statement, balance sheet, income statement. How can we start? First step, project sales. Let's say sales will go up 15% next year. And we are assuming all else will be tied to sales. So I already told you, historically, 20% of sales is net income, 50% of sales is total asset. So now we are forecasting sales, so 50% growth next year, which is 2300, 80% cost, 20% net income. So next year, if sales go up by 15%, that means our new sales value should be 2,300 and our new net income should be 460, which is 20% of new sales. All items are tied directly to sales. That means all items will grow accordingly. If you look at the asset, the new asset is 50% of sales. New sales 2,300, 50% of 2,300 is 1,150. Now, how can we balance? How can we balance? Because we have new asset 1,150. Initially, we had $400 of debt, right? From last year. How can we balance? Now, this is a management decision. So new assets, are we financing from debt or equity? How can we balance? This is a new management decision. So it's a plug variable. So now we can think about, we want to do dividends as a plug variable. We want to do dividend as a plug variable, and we want to keep this one as a sales ratio. So 400 over 2000, 600 over 2000. Let's keep this ratio here. So now what we're thinking, using this ratio of debt and equity as of sales, our new value should be 460 and 690. 460 and 690. So that 60 is basically additional debt issuance and additional 19 equity values coming from retained earnings. Okay. So now from this 460 value, we are retaining 90 and less 370 we are paying as dividend. So what you decided? We decided dividend as the plug variable. So we'll keep debt and equity ratio as it was before last year, and all addition of equity should be coming from dividend. So this is case one. In case two, we have decided debt is the plug variable. We'll only play with debt. So now if you look here carefully, what we are doing, we are keeping all this net income as retained earnings, and then using those net income, we are paying back the debt. So if you look here carefully, our new asset is 1150. This is our retained earnings because we are keeping 460. 600 plus 460 is our new equity value, but using that retained earnings, we are paying back debt. So wrap up what we are doing. So case 1 and 2. Okay, so let's have a recap. Case 1, dividends are plug variable, right? And we decided debt and equity ratio should be as is. So like, what was the debt and equity ratio before as of sales? So we are maintaining the same ratio, right? So what we are doing, we are using dividend as a plug variable. So now this is the new debt. So equity has to be 690, right? To make sure total liabilities and equity holders is 1150. So this new 90 is kept from the dividend, from the net income. All else is paid as dividend. So 460 minus 90 new addition equity, 370 is paid to dividend. Case 2, we are saying debt is the plug variable. So we'll change debt and we not pay any dividend. So all this 460 is kept. Now this is our new equity value, 1060, and the difference between 1150 and 1060 is debt, 90. So the difference of 400 to 90 will be paid back. We'll repay that debt. So this is the thing, the management will decide what should be the plug variable, and then they play accordingly to make sure the balance sheet balance. If you have any questions, feel free to write it down. We can answer in the next class. Now, Some implications of percentage of sales approach. First of all, we are trying to say that we want to forecast sales and all else is tied up with sales, right? We're talking about interest payment, depreciation, asset growth, all else are tied up with sales. So there are some issues. There are some issues because costs are tied up with sales. So that's correct. That's the right assumption. So cost of goods sold are tied up with sales. And in those cases, profit margin is generally constant. But depreciation, interest expense in general may not be tied up with sales. Interest expense is depending on how much or what rate you are paying and how much debt or loan you have. Let's say you have 5% interest rate and you borrowed, let's say, $400. So going forward, each year you will pay 5% on $400, which is around $20. This is not fixed with sales. You can have more sales, you can have less sales going forward, but each year you will pay $20. So this is not tied up with sales. Depreciation, that's not tied up with sales. Let's say you have $1,000 fixed assets and that will continue for 20 years. So that means $50 is your depreciation each year. Doesn't matter if you have more sales, if you have less sales, depreciation is basically tied to that fixed asset. So there are some things, this is not tied up to the sales. In those cases, your profit margin should not be constant because in these projections, we are saying that 20% is net profit margin in history. 20% is net profit margin in history. That means 20% will be net profit margin in future. But if your cost, depreciation, interest expense are not tied to sales, your profit margin should not be constant. Dividends is management decisions and they do not vary with the sales. In industry practice is like dividends are kind of standard decisions. So company wants to maintain a constant dividend payout ratio each year and it doesn't vary with sales. And this also affects your retained earnings decisions, okay? So we cannot say that our retained earnings should be a fraction of sales, no. Because corporations will always pay fixed dividend per share. If they do so, if sales vary, your dividend to sales ratio will definitely vary. And that will not be fixed. Sometimes, in the last example, we are saying that our fixed asset vary with sales, right? Which is not also true. Accounts payable in general vary with sales because if you can generate more sales, you have to have more inventory on an average. If you have more inventory, it is also possible you're buying them in credit, paying them later. So accounts payable is directly tied to your sales. Notes payable, long-term debt, they are not tied to your sales. This is a management decision. Sometimes management want to issue debt. Sometimes management do not want to issue debt, irrespective of sales. In those cases, your debt to equity ratio in total asset will change, but not tied to sales. It's totally tied to management discretion. And as a result, equity will change too, because debt and equity ratio, it's a management decision. It's not tied to sales. And also, as we said, dividend is also management decisions. Retained earnings will be a management decision. It's not tied to sales. Quick recap. The assumption that everything will vary with sales is not correct always. Why? Cost of goods sold, accounts receivables, accounts payables, they are vary with sales because they are directly tied to sales. If you can generate more sales, you have to pay for more cost of goods sold, right? If you can generate more sales, sometimes you have sell them in credit, your account receivable goes up. If you can generate more sales, that means you're also buying inventory, you can buy them in credit, you're generating more accounts payable, right? Those are tied to sales. Investment in fixed asset is not tied to sales. That's why depreciation expense is not tied to sales too. Management decide how much debt and equity ratio they will want to maintain going forward. That's why interest expense on your debt not tied to your sales. That's why dividend payment, retained earnings is not tied to your sales. So these are some implications of assuming that all else is tied to sales. So that's all for today's class. Read the book, watch the lecture videos, and write down if you have any questions. Maybe you may struggle a little bit in this area. We can definitely go over in the next class. So that's all. See you in the next class.